Hi, everyone. Thanks for having me again. My name is Alex. My background was initially in machine learning with my first company, got acquired, and then joined Ledger Prime, where I ran the DeFi book. So deployed capital pretty much anywhere on-chain and liquid, and faced a lot of issues with cross-collateralization in general, which led us to incubate Fractal within the fund initially and raise the seed round, led by our friends at Hack right here. And we're about to launch. So what Fractal does is essentially building margin infrastructure to enable cross-collateralization between both DeFi assets and OTC bilateral agreements.
Hello, I'm Adeline Zhou. I'm at Chainlink, Chainlink Labs. We help provide Oracle services for the various different blockchains. Basically, we allow blockchains to communicate and connect with on and off-chain data. And then, we work with, I think, about 75% of all DeFi projects, so we know the space well.
Hey guys, I'm Alex. I'm the founder and managing partner at Hack VC. We're an early stage crypto venture fund. Before that, I helped start the crypto firm Dragonfly, which is one of the largest firms in Asia, and the crypto practice at Bain Capital Ventures. And I've been a crypto VC for about 9 or 10 years now, starting in 2014.
Awesome. And then quickly, my background. So I'm Aya, formerly part of the founding team of FalconX, and before that, Pantera Capital. So why don't we dive right in? It's been a crazy year in crypto, to say the least. Why doesn't everyone go around, and we can talk about anywhere between 1 to 3 key limitations that you've seen in the market following the FTX debacle, as well as market movements like the Terra Luna crash as well too. Alex, why don't we start with you first?
Sure, yeah. It's been quite a year. This is probably the third full bull bear market cycle that I've been investing through. The first one in 2014, when I bought my first Bitcoin, it was $800, and there was this rumor that this Japanese exchange was going to go under, and then I kind of thought the whole industry would collapse after that, and I just left the space and I became a general VC, and amazingly, it came back in 2016. And so, I think the big lessons learned are, most of the centralized parts of crypto, at least for the last few years, they've really been operating like shadow banks. And, there's very little aspects of them that there's not much decentralized infrastructure underpinning them. Many of them sort of claim that they did have a lot of decentralized infrastructure, but they didn't. I went to Coachella last year, which was sponsored the hell out of by FTX, and I got a nice little FTX NFT. And after the bankruptcy, it was gone. It's like a 503 error or whatever it was. It was stored on centralized FTX servers that all went down after the bankruptcy. So is that really an NFT? Is that really crypto? What me and all the other attendees at Coachella were introduced to? Probably an early version, a pretty bastardized version. So, but I do think the one silver lining to everything that's happened with the blowups and centralized finance and centralized infrastructure and FTX is that it sort of proves the importance and necessity of actually decentralizing as much as you can. There was one amazing anecdote that I saw, which was in the days before the FTX bankruptcy, this researcher at Coinmetrics, this data company that I helped seed years ago, he did some on-chain sleuthing, and he found that sometime in September, $8 billion of FTT tokens were moved on-chain. This was an epic thread. And it was the most by far, it was 1,000x more than any FTT had ever moved before that. And what it was basically $8 billion of FTT tokens moving from Alameda wallets to FTX wallets. And at the time, nobody really knew what was going on. Sam actually posted on Twitter, oh guys, I'm just, heads up, just rotating some assets. It's all good, And of course, what actually happened and what this researcher guessed at a few weeks before the bankruptcy and before it all came out was that this was basically the main, horrible fraudulent transaction. This was 8 billion of FTT token going from Alameda to FTX. And behind the scenes, about $8 billion of customer funds were probably moving from FTX to Alameda. And that's normally it takes you a long time to figure that out. It could take you months, it could take you years. The Madoff scandal It's like 30 years before people figured out that Madoff was running a Ponzi and a fraud, right? And this was because, FTX is a crypto company and they're forced to put a lot of transactions on chain. So my lesson learned is like, the more you can do on chain, the better. The more transparency, the more you could force the companies and protocols, to put activity on chain. Like, that's the silver lining, and I think that's the kind of stuff that if more of it happened in the future, the FTX wouldn't be possible, and not even FTX, but like Lehman wouldn't be possible, and MF Global, all these things, right? Anyway, I'll let you guys speak now too, but that's my one little fun anecdote to start that I found to be interesting, at least, yeah.
I mean, on our end, after FTX happened, all of a sudden you saw people talking about proof of reserves. And proof of reserves is, it's like proving on chain that you actually have the reserves backing whatever, stable coin or currency that you have. And at Chainlink, we've actually had this product for a long time and, been knocking on doors. We're like, hey, you might want a proof of your reserves, your CeFi project. And before, none of them cared. But after that, like all these inbound calls started coming in, being like, actually, yes, we need to prove to our users that we are not, taking their money and using it multiple times, or putting in different leverages that aren't, good for the user. So I think for us that was really good because now slowly more CeFi projects are realizing that they need to be a bit more transparent with where user funds are. We saw Binance at least sort of go in that direction, and it's interesting, like some projects still don't want to do it and some are like fully embracing it, and so you kind of see, right, you're like, hey, wonder why you're not using proof of reserves. Is there something else behind the scenes? And so if you are trying to put your money in different types of CeFi or exchanges, take a look at that to see, are they actually legitimately embracing this transparency that could be on chain.
What I'd say is, I think, echoing Alex's point, most of the CeFi players today are effectively traditional finance venues that are somehow trading an asset that happens to be crypto. Could be silver, it could be gold, it could be stocks, it could be tomatoes. Nothing in their operation actually is crypto specific, aside from the fact that they have to send crypto transfers back and forth. And so that's one problem. We haven't really achieved anything on the CeFi side of things in terms of actually using the blockchain as a settlement layer and the back-end system that it should be. One thing though is that we still do have to give credit to FTX for building the best portfolio margining system that was available to date. Capital efficiency is very important for institutions, and fully collateralizing everything is just impossible. And so the problem, and where they took it too far, was that you had Alameda on the other side, and Alameda had very specific permissions. They were the only ones who could actually print trade on the order book, OTC large block trades on the order book, and then I only know the tip of the icebergs of the other privileges that they had. And so one lesson for me is that the only way that we move forward is by building a system that doesn't rely on people's good behavior to function properly. It just has to be built into the system. And that relies on having a credibly neutral clearing and risk engine in the middle that doesn't have an incentive in better pricing and is just acting as the effective clearinghouse on chain. We need to solve for under-collateralization, but there needs to be an independent, what does the clearinghouse for crypto look like today? That's an open question. That's something that we're trying to build, and it's something that's going to take a lot of time. But the first step to get there is, hence the title of this talk, is we need to standardize the way assets are encoded, and ERC 4626 is a first step there in terms of how assets interface with one another and can be cross-collateralized.
Yeah, I think one lesson I learned is there's a dichotomy between like the primary market evaluation and the secondary market evaluation. Since 2020, there's a lot of hot money in the space with macro stimulus, a lot of institutional guys moving into the market. In 2021 alone, there are 30 crypto companies market over 1 billion valuation. And at one point, FTX almost have market cap even bigger than Coinbase at the one point. So that's how crazy it is. And with the FTX, at the time, there are over like 25 different hedge fund, growth equity, try to buy for that market. What I want to point out was I think because the market exuberance, people sometimes overlook the risk. Similar for institutional investors as well, how we actually properly understand and evaluate the company and what's the right valuation framework, what's your exit path is an awakening moment for us after the FTX moment. The second thing I want to point out is it's not just one company they fail, but actually the implication for industry touch every single corner across their private market portfolio, all the collateral, all the token they're holding. It has a massive impact, almost a systematic impact to a lot of players in the market. So moving forward, it's more like we talk about standardization in the space. It's also how across the industry, how we more systematically think about this like risk factor and collectively to establish the system better.
Yeah, absolutely. I know we touched on a number of different types of standardization. Switching gears to just quickly focus on trends, obviously we have DeFi and yield is a big aspect of that. We also have, with interest rates increasing this year, a lot of focus on real world assets and real applications on chain because of the need to find real yield that maybe DeFi doesn't necessarily have today. And so from the beginning of the year, Jan, DeFi TVL itself alone is up 30%. With real-world assets, you're seeing a number of both treasuries, T-bills getting brought on-chain. What are you seeing today in DeFi or even just trends around real-world assets that excites you and what you're looking forward to through the rest of 2023? And Adeline, why don't we start with you and then we'll bounce around.
Yeah, I think you summarized it well because the yield in DeFi right now like is low, and when you look at T-bills that are trading at 5%, it's like, hey, let's just put T-bills on the blockchain and trade those. Like you get automatically 5%. And so I think we're seeing like actually dozens of projects coming out in the RWA space. That's T-bills are what a lot of them are starting with first, and then they're saying, hey, I'm going to tokenize receivable loans. I've heard of tokenizing real estate. I've heard of tokenizing almost like supply chain, invoicing. Basically anything you have it, they're all kind of trying to move those on chain. I think the one thing, though, to think about is how, especially with T-bills and stuff like that, what kind of regulatory restrictions they'll have, especially as you target those. It really literally becomes a security. And so as we see with regulation coming, how that affects it.
Era?
I think one interesting metric to look at nowadays, I think TVL is not the correct metric to evaluate the liveliness of a DeFi protocol anymore, right? Nowadays, after the 80% depreciation with the market last year, there's a lot of different metrics to focus on. What's the actual transaction volume? Where they do the user acquisition? Like what's the active wallet? There's a lot of different metrics to actually understand the adoption of that DeFi platform. Because today, if I look at infrastructure, block space is no longer a scarcity. Every single corner, there's another AMN, there's another DeFi lending platform, right? How you compete, how you differentiate, it's really focused on go-to-market. And that's where I think all of us, we start to focus a lot more, what's your actual use case, utility, user adoption? That things should matter a lot more moving forward.
Yeah, I mean, it's ironic because I think it's pretty clear that like of all the use cases of crypto outside, I guess like the Bitcoin one, DeFi has by far the farthest product market fit, right? It's and also it's the most stable in many ways. Like even during the FTX crash and 3AC and all the credit blowups of the last year, DeFi kept spinning. Like none of the chains like went under collateralized or MakerDAO didn't go. It was actually different. And in March 2020, the last cycle, like several key DeFi protocols actually like sort of broke fundamentally. Like MakerDAO had a big issue where a bunch of the collateral was like accidentally sold. Like ETH was sold for like $1. It was crazy. So in many ways, it's the most mature. And if we think about what standardization means in crypto, it's basically about standardizing to like let's use DeFi and Ethereum and maybe other layer ones too as a settlement layer and as like these sort of shared protocols that like the whole financial system can be built upon. But yeah, we do have a little bit of the central irony is we do have a bit of a product market fit problem, which is that the yields are lower than T-bills, which is pretty insane because it's hard to believe that like lending on Aave is actually like a more risk-free thing than just like lending against the US government. Like maybe if you're sort of very ideological or, I don't know, you can't access T-bills, it's a whole thing, right? your Justin Sun in some other country, whatever, you know. But yeah, so I think the process forward is we just have to move as many of these real world assets and real world yields on chain as possible. And I love the whole, like the idea behind like staked ETH as a sort of collateral asset is so cool. It's like, okay, instead of ETH being the collateral, and when you do take loans, you get additional yield on top of ETH, you could get yield on top of staked ETH, right? And you could just stack these things up and up. And of course, in CeFi, this stacking is bad. Like you don't know what's underneath, and you have these, you know, mortgage-backed securities that are like tranched all the way through, and you don't know what's going on underneath it. But in crypto, you know every layer. It's all transparent, right? So if we get to the world where like mortgages or T-bills or whatever are like, you can like tokenize them in synthetic formats and have those be the main collateral behind like Aave and other protocols and what Fractal is doing, that is quite cool. I mean, I'm looking forward to that happening in the next few months. Yeah.
On our side, I think what's been interesting to see is that really for the past 2 years, no real new primitives were invented in DeFi. You had a lot of forks and a lot of other AMMs that launched on chain number 6, 7, 8, 9, 10, etc. Another compound fork, another Aave fork, etc. And it's actually been nice to see some innovation coming back at the primitive level. So there's starting to be some innovation again in order book style exchanges, derivative protocols, fixed rate lending, and then so that's in the pure, you know, DeFi native world. And then obviously it's been touched on before, but as the risk-free rate in off-chain is higher than the risk-free rate on-chain, there's an incentive. The market is doing its thing of bringing that risk-free rate on-chain as well. And so for us that are hoping to sit at the intersection and being able to cross-collateralize across all of these assets, it's been refreshing to see that obviously there's very little capacity in those products for now, and most of the demand is for the blue chips that you all know. But starting to see some new financial primitives that we are able to integrate and make things a lot more interesting for us.
And lastly, I know we have to wrap this up, and so why don't we go around, we're obviously at ETH Denver, so why don't we go around and maybe a word or two around some of the key themes that you've taken from this week that you're most excited for, whether it's for Q1 2023 or what's being done and built for the rest of the year. We'll start with you this time.
For sure. Yeah, I mean, the thing that we've been harping on in DeFi is great. Obviously, Fractal, one of our portfolio companies, you guys are building like quite a cool primitive to build like under collateralized lending on chain in a way that isn't totally like opaque and you can like see everything that's happening. That's amazing. I would say like a little bit longer out is the concept of like private decentralized applications and private DeFi. And this is like, if you've been in crypto long enough, like everything that's old is new, and it, you know, like 6 years ago we were talking about Monero and Zcash and private transactions. But the thing that is really exciting isn't just private transactions, it's like private, like entire financial operations of a business or something. So if you're able to participate in DeFi protocols as an enterprise or run your entire business as a DAO, you know, if you want to do that, you basically can't do it where, like there would be no business that would work where their entire P&L and their income statement and their balance sheet is like totally on chain for anybody to see, right? Like you need to have an ability to obfuscate this. It's not even privacy for like ideological purposes or, you know, human rights or whatever, the stuff we were talking about 10 years ago. It's privacy for like enterprise adoption, right? So layering that on, like sort of private apps, I think that'll probably be possible by the end of the year. We'll see, you know, give or take a few months, but that should be quite cool too.
I think on my end, I'm excited about a lot of the staking stuff that's happening and the distributed validator technologies, EVTs. I think there's just a lot coming, you know, once Ethereum stake can be unlocked. And so I see a lot happening there. So I'm looking for there. And then the real world assets, I think just continue to see where that goes and some of the derivative stuff that you've mentioned in the DeFi space. And then also more the institutional, what you guys are doing at Fractal too. It's like, hey, how do we bring more institutions into our space? I think those are some of the trends that I'm very excited about.
On my side first, I was pretty surprised by the positive energy of this conference. I expected it to be a lot more bleak after the past few months that we've had. So that's been a good surprise. And beyond that, I think DeFi is a little bit of a misnomer because decentralization is a spectrum. I'm interested about on-chain finance and getting people to use the blockchain as the backend, as the more efficient backend without having 16 intermediaries when you put on a transaction or you pay with your credit cards, and you have to go through intermediaries 1 to 16, and everybody takes a cut in the middle. And so, some of those protocols will have to be KYC'd. Some of those protocols will be centralized, but operate on a permissionless blockchain that acts as a censorship-resistant backend system. And so, if we can just achieve that before full censorship and full decentralization, that'll already be a good outcome.
Yeah, I think to build on what they just mentioned, I think this year will be a landmark year for another resurgence of infrastructure building with the modular blockchain, right? With the rollup, with the CK rollup coming up. Also yesterday with the whole entire shared security paradigm and so mesh security paradigm brought up to space. We're looking to a new wave of like block state coming online with a new wave application being built on those, whether it's an L2 or like a mesh security platform. So I want to highlight there is the momentum is coming right now, and I think Denver is really a great start to begin this year, and very, very exciting. I think by the end of last year, we'll see a new renaissance.
Awesome. With that, thank you so much for having us. And thank you to our panelists.
Thank you.
Thanks, everyone.
Yeah.
Thanks.